China once held over $1.3 trillion in United States Treasury debt. Today, that number has collapsed by more than 75% from its peak. Not trimmed, not rebalanced, liquidated. And while you were working, saving, contributing to a retirement account, trusting that treasuries were the safest asset on earth, the second largest economy quietly started walking away from the foundation of the global financial system. This isn't rumor. It isn't speculation. It's published Treasury International capital data, public, verifiable, filed by the United States government itself. Ignored by most people who should be paying attention. Here's why this matters to you personally. Treasury bonds aren't abstract. They set mortgage rates. They anchor pension funds. They determine how expensive your government's debt becomes, which determines how aggressively they print. When confidence in treasuries breaks, purchasing power breaks with it, slowly at first, then all at once. And China isn't alone. Sovereign funds, central banks, foreign governments have been reducing exposure for years, quietly, methodically. No press conferences, no headlines, just steady exits while the public is told everything is fine. This is the part most people miss. Countries do not abandon reserve assets unless they see something coming. They don't walk away from safety unless safety is gone. This is not political, it's not ideological, it's mathematical. And here's the uncomfortable truth. This exact behavior has happened before. Same asset, same warning signs, same official reassurances. Every single time it ended the same way. Currency debasement, inflation, financial repression, wealth transferred from the unprepared to the informed. By the end of this video, you'll understand why this pattern always repeats, what stage we are in right now, and what people who recognize it early actually do to protect themselves. But here's what nobody's asking. What China did is not an isolated headline. It's one data point inside a much larger global shift. Foreign ownership of United States Treasury debt has been collapsing for over a decade, and the decline has accelerated sharply since 2018, after COVID. After sanctions weaponized the dollar, after governments realized reserves could be frozen overnight. At its peak, foreign nations owned more than 40% of all marketable U.S. debt. Today, that share is closer to 23% and falling. Japan is down. China is down. Emerging markets are down. The direction is unanimous, even if the reasons differ. This matters because treasuries are not just another asset, they are the foundation asset. They sit beneath banks, pensions, insurance companies, and global trade settlement. Every risk-free rate, every mortgage, every discounted cash flow model starts here. When demand for treasuries weakens, the entire pricing structure above them destabilizes. To keep the system functioning, someone has to buy. If foreigners won't, domestic institutions must. If domestic institutions can't, the central bank steps in. That's when distortion begins. Yields stop reflecting risk. Prices stop reflecting reality. Inflation becomes policy, not accident. And this is where the acceleration matters. Since 2020 alone, the United States added more debt than it did in its first 2 centuries combined. Trillions issued into a market where the natural buyer is quietly leaving. That imbalance doesn't resolve gently. The urgency is timing. The shift isn't theoretical or decades away. Treasury auctions are growing larger, while bid to cover ratios quietly weaken. Yields spike, then get capped. That tells you demand is price sensitive and increasingly artificial. When foreign buyers retreat, volatility rises. When volatility rises, policymakers intervene. And every intervention pulls future pain forward. Pension funds depend on stable yields. Retirees depend on purchasing power. Governments depend on confidence. When trust erodes at the foundation, everything above it starts to wobble. Not immediately, gradually, then suddenly. The difference between those groups is not intelligence, it's attention. One watches headlines, the other watches flows. Most people are watching stock prices. That's the distraction. The real signal is underneath, in the bond market, where insiders operate and narratives die. When the largest holders step away, they're telling you something without saying a word. And that creates a survival divide. Those who understand the signal adjust early. Those who wait for reassurance stay exposed. Same data, same system, very different outcomes. History shows which group keeps their wealth. This isn't chaos. It's a pattern playing out now globally. To understand what's happening, you need a framework. Not opinion, not politics. A repeatable cycle that has governed sovereign debt collapses for centuries. Same stages, same warning signs, same outcome. Stage 1 is accumulation. Trust is high. Debt is viewed as safe. Foreign buyers accumulate bonds willingly because the system works. Debt to GDP rises, but slowly. Growth masks risk. This stage lasts decades. It feels permanent. Stage 1 complete. Stage 2 is overextension. Debt accelerates faster than growth. Governments borrow to maintain living standards, fund promises, and paper over structural problems. Debt to GDP surges. Deficits become structural, not temporary. This stage lasts years, not decades. Stage 2 verified. Stage 3 is the silent exit, This is the most important stage and the one almost everyone misses. Smart money doesn't panic, it reallocates. Sovereigns reduce exposure quietly through maturity runoff, currency diversification, and alternative reserves. No press releases, no alarms. This stage is invisible until it's over, and it happens faster than people expect. Stage 3 confirmed. Stage 4 is the public reckoning. Inflation replaces default, capital controls replace free markets, financial repression replaces yield. The public finally notices because pain becomes unavoidable. Savings lose purchasing power. Trust collapses. This stage happens in months. The key insight is duration. Accumulation takes generations. Overextension takes years. The exit takes months. By the time the headlines catch up, the opportunity to move has passed. This is why mainstream narratives always sound calm during stage 3. The system still functions. Markets still trade. Stocks can even rise. But underneath, flows are changing. Foreign reserves shift. Debt holders become issuers themselves. Central banks replace organic buyers. Debt to GDP in the United States now exceeds levels seen after World War II, without the growth tailwind that followed. Foreign reserve composition is changing globally, away from treasuries and toward neutral assets. These are not opinions. They are reported facts. When you line up the stages, when you map the data, when you watch behavior instead of commentary, the conclusion isn't ambiguous. History shows this moment always feels calmest, right before recognition arrives. Yields distort. Liquidity thins. Officials reassure. Insiders reposition. Nothing breaks publicly. Everything shifts privately. That contradiction defines the exit phase. Most people notice far too late, historically speaking. We are not in accumulation. We are not merely overextended. We are watching the exit. We are in stage 3. And stage 3 never announces itself. It just leaves footprints in the data for those trained to look. Let me prove this isn't theory. At its peak, the British pound was the unquestioned global reserve currency. In 1913, sterling dominated nearly 60% of global trade finance and international lending. London was the center of global banking, insurance, shipping, and commodity markets. The British Empire controlled ports, trade routes, and raw materials across continents. British government bonds were treated as the ultimate safe asset. Trust was absolute. Capital flowed freely. Stage 1 complete. Overextension arrived through war. World War I strained public finances. World War II devastated them. Britain financed survival through borrowing, asset sales, and emergency loans. By 1945, debt to GDP exceeded 250%. Industrial capacity was damaged. Productivity lagged the United States. Growth slowed sharply. Deficits persisted even in peacetime. Borrowing replaced production as the economic engine. Stage 2 verified. What followed was not collapse, it was retreat. Foreign governments began reducing sterling exposure quietly years before the public noticed. Trade settlements shifted toward dollars. Gold reserves drained steadily. Britain negotiated a massive loan from the United States in 1946. Just to stabilize its balance of payments, there were no riots, no dramatic headlines, just methodical reallocation by informed actors. Stage 3 verified? Check. The reckoning came later. In 1949, the pound was officially devalued by 30%. Inflation surged. Capital controls were imposed. Living standards declined for decades. The empire unraveled. Britain never regained reserve currency status. The loss was permanent. Where did the power go? Across the Atlantic. The United States dollar emerged after World War II as the new anchor, backed by gold under the Bretton Woods system. For 2 decades, confidence held. Trade expanded. Growth masked risk. But by the early 1960s, the pattern returned. Vietnam War spending ballooned. Social programs expanded. Deficits became structural. Dollars accumulated overseas faster than gold reserves could support. Stage 2 verified. Foreign governments noticed first. France, under Charles de Gaulle, openly challenged the system. Beginning in the late 1960s, France demanded gold in exchange for dollars. Others followed quietly. Gold flowed out of Fort Knox. The numbers were public. Officials reassured relentlessly. Stage 3 confirmed. In August 1971, the illusion ended. President Nixon closed the gold window overnight. Convertibility ended. The dollar was devalued in real terms. The 1970s followed with double-digit inflation, oil shocks, wage and price controls, and negative real returns. Savers lost purchasing power year after year. Debtors benefited. Stage 4 complete. But maybe that was unique, until it happened again. Japan entered the late 1980s as an economic juggernaut. Explosive growth, massive trade surpluses, asset bubbles in stocks and real estate. Government bonds were trusted implicitly. When the bubble burst in 1990, growth collapsed. Tax revenues shrank. Deficits surged. Debt to GDP climbed past 200%. Stage 2 verified. What followed was not default. It was repression. The Bank of Japan suppressed yields through bond purchases. Domestic banks absorbed debt. Foreign participation declined steadily. Markets appeared stable. Returns vanished. This was a silent exit disguised as control. Stage 3 verified? Check. The result was decades of stagnation, near zero growth, vanishing returns, asset prices frozen, savers punished slowly. Japan did not implode. It faded. Wealth survived only for those who adapted early. Same pattern, same stages, same outcome. Different century, different country, same math. Let's map this onto today. Stop talking about history and look at the United States right now, because this pattern is no longer theoretical. It's measurable, it's documented, and it's accelerating. China's Treasury holdings peaked at $1.3 trillion in 2011. Treasury International Capital data shows they are now under $800 billion. That is not a marginal adjustment, it's a multi-$100 billion withdrawal from the core asset of the global system. And it didn't happen during a crisis. It happened quietly, over time, while headlines focused elsewhere. Japan tells a similar story, still the largest foreign holder, but steadily reducing exposure as domestic pressures mount. Russia exited almost entirely after sanctions risk became explicit. Middle Eastern sovereign wealth funds shifted allocations away from treasuries. They moved toward infrastructure, commodities, and strategic assets. Different motivations, same direction. The common denominator is not politics, it's trust. Sanctions changed everything. When reserves were frozen, every central bank in the world learned a lesson they could not unlearn. Reserves are only safe if they are politically neutral. Treasuries are no longer neutral. That realization didn't trigger panic, it triggered planning. Planning looks boring, it looks gradual, but it's decisive. Now here's the critical question most people never ask. If foreign buyers are leaving, who is buying instead? The answer is domestic institutions and the Federal Reserve, pension funds, banks, insurance companies. And when they can't absorb issuance at market clearing prices, the central bank steps in. That's not theory, it's balance sheet reality. The Federal Reserve's assets expanded from under $1 trillion in 2008 to nearly $9 trillion at the peak. That is the buyer of last resort replacing natural demand. This substitution matters. Organic buyers care about yield and risk. Forced buyers care about policy and stability. So when policy replaces price discovery, markets stop signaling danger clearly. Yields become managed. Volatility gets suppressed. The system looks calm even as pressure builds. Well, you can see this in the yield curve. Short-term rates spike as the Fed tightens. Long-term rates resist, then jump suddenly when auctions weaken. Term premiums rise, then get pushed back down through intervention. That instability tells you demand is conditional, not confident. Treasury auctions now routinely require higher yields to clear. Bid-to-cover ratios fluctuate. Primary dealers absorb more issuance. Foreign participation shrinks. None of this makes headlines. All of it is reported. At the same time, central banks are buying gold at the fastest pace in modern history. Thousands of tons accumulated over the last 2 years alone. Gold doesn't yield. It doesn't pay interest. It just sits there, which is precisely the point. It carries no counterparty risk, no sanction risk, no promise risk. When you add it up, when you watch who is buying what, when you track flows instead of narratives, the message is unmistakable. Confidence in U.S. debt is eroding at the margin, and marginal buyers are all that matter. This is exactly what Stage 3 looks like. No crash, no collapse, just quiet exits by those with the most information and the most at stake. The public is told the dollar is strong. Markets are resilient. The economy is booming. That's the official story. Behind the scenes, the foundation asset is being absorbed artificially while natural demand fades. We are in Stage 3. The exit is already happening. And this is where the danger lies. Stage 3 feels survivable. It feels manageable. That's why most people don't act. But history shows this phase never reverses on its own. It transitions. Rising term premiums, weakening auctions, accelerating gold accumulation, these are not random data points. They are signals. And signals only matter if you respond before they become headlines. So why are they telling you everything's fine? I know what you're thinking. This time is different. We've heard that phrase at every turning point in financial history. It was said in London before sterling collapsed. It was said in Washington before the gold window closed. It was said in Tokyo before decades of stagnation. Same confidence, same logic, same mistake. The belief is understandable. Technology is better, markets are faster, policymakers are smarter. But debt math never changes. When liabilities grow faster than productive output, something must give. Either growth accelerates, defaults occur, or purchasing power is sacrificed. History shows which option governments choose. Stage 3 always ends the same way.